And for Bitcoin, I think my advice tends to be that there's a lot of numbers that make sense, but zero is probably not the right one. There are people that are more than 100% all in, like they're levered long. And there are other people that a 3 or 5% allocation could make sense. But I think that if you don't own any, and if you've never sent a Bitcoin transaction, I do think that going forward, that's a good thing to have done. It's a good thing to have, at the very least, you've educated yourself on the functionality of this, but it's a different way of doing money. And I do think that going forward, just zero is not the right number. It could be an amount that's not that important to you, but at least you have skin in the game now, and maybe would pay attention to it going forward.
A lot of people are making a quiet mistake right now. They own zero Bitcoin. Not because they studied it and rejected it, but because they never bothered to look. They shrug it off as irrelevant or too risky, while the financial system is slowly being rewritten without waiting for anyone. More institutions, central banks, and everyday people are rethinking how we store value in a world where money itself is changing. LYN ALDEN isn't saying to go all in or sell your house. Her point is simple: zero might be the wrong number. Even a small amount, a single transaction, can shift your perspective and show you how this parallel system actually works. Because until you've tried it, Bitcoin is just theory. And theory doesn't change habits, skin in the game does. So if you've been sitting on the sidelines, maybe it's time to dip your toe in. Not to get rich overnight, but to learn what the future of money could really feel like.
Throughout most of kind of the past several decades, when the central bank perceives that inflation's higher than they'd like it to be, and a lot of this is arbitrary. Like even their targets of where they want inflation to be are pretty arbitrary. But in the U.S. and globally, they've decided on certain numbers. Currently, 2% is at least the way they measure it, their target. When it gets too high, they have a variety of tools to try to slow down that inflation. And primarily what they go after is to try to reduce the amount of bank lending. Because in our current fractional reserve banking system built on top of central banking, when a bank lends money, it actually creates money. And so, for example, in the 70s, which were a well-known inflationary decade, there were multiple things that contributed to the inflation, including, for example, oil shortages. But a key background thing was that there was an above average rate of bank lending happening and therefore an above average rate of money supply growth happening. And that had a lot to do with demographics. The baby boomers who were young at the time were entering their home buying years, which is kind of the peak period of credit formation. And so that was a more inflationary time. And what central banks typically do when they're experiencing this higher level of inflation is just try to slow that down somewhat. They'd rather have a recession than let it just get completely untethered from expectation. They're trying to protect against people totally losing faith in the currency because weakness can beget more weakness. Kind of like how in nature, if an animal's weak, predators will go after that one. The same thing happens to currencies, especially emerging market currencies, but it can happen to developed ones too, which is if a currency is weak and it's devaluing quickly and the money supply is growing quickly and the interest rates are not sufficiently high, then actually more people will come in and borrow it and buy almost anything else with it. They'll buy another currency potentially that yields better, or they'll buy gold or real estate or pretty much anything that they perceive as being more scarce and likely to appreciate relative to that currency. And that ironically creates even more of that currency. So weakness begets more weakness, and they try to short circuit that by raising interest rates to try to, one, strengthen that currency relative to some others, and two, to make it less desirable to borrow it under more circumstances. So some entities are borrowing it, but they're basically increasing the hurdle to make it less desirable to borrow, and that is an attempt to slow down the money supply growth. What's troubling about fiscal dominance is that so during the 70s, when they raised interest rates like that, it has kind of two effects, but one's bigger than the other. So the bigger effect is that it slows down bank lending, which is what they're trying to do. The negative effect is it actually increases the federal deficit because the government's interest expense is now higher. They're paying higher average interest on their existing debt. And so they're actually ironically increasing their deficit, which could be inflationary. But their total bank lending is a much bigger negative effect than that deficit. The problem in fiscal dominance is that's reversed. So in the current era, the U.S. government's average annual fiscal deficit, like how much the difference between our taxes and our spending, that's a bigger amount than net new bank loans in a given year. And it's even bigger than the sum of net new bank loans and net new corporate bond issuance. So
Whoa.
basically, yeah, public sector credit formation is now bigger than the private sector by several ways of measuring it. And the problem is that when you have over 100% debt to GDP, unlike the 70s where they had 30 something percent debt to GDP, so now you have over 100%.
Still paying taxes on your crypto gains? What if you didn't have to? With ITrust Capital, you can buy and sell crypto inside a tax-advantaged IRA, giving you a smarter way to grow your portfolio without worrying about capital gains tax. That's why they're the #1 crypto IRA platform in America, with billions in tax-advantaged transactions. There are multiple ways to fund your account. You can make a contribution, transfer an existing IRA, or roll over an old 401k or employer plan. You'll get access to a wide range of digital assets, low fees, and 24/7 trading, all backed by secure, one-to-one asset ownership with institutional-grade custody. And if you have questions, ITrust Capital offers 100% US-based customer support with real people ready to help. Click the link, use code DOSE7, and get your $100 funding bonus today. Start building your crypto wealth, tax-advantaged, with ITrust Capital.
When the Fed raises interest rates to try to slow down bank lending and try to harden the currency, they actually blow out the fiscal deficit by an even bigger number than they slow down net new bank loans.
The old 60-40 portfolio is losing ground as bonds weaken and currencies erode. Investors are shifting toward equities, hard assets like gold, and increasingly Bitcoin. Once limited to individuals, it's now reaching corporate treasuries, pension funds, and even sovereign reserves. Accounting rules once discouraged adoption, but with new clarity and Bitcoin's market cap above $2 trillion, momentum is building. Bold, forward-looking firms are leading the way, positioning Bitcoin as a serious asset in global finance.
The way that I've approached investing for myself and my clients is I generally say a 3-pillar portfolio. So most people are they think of the 60-40 portfolio, so 60% stocks, 40% bonds. The problem is that in fiscal dominance, bonds don't do very well. They generally lose a lot of purchasing power. And so my approach is instead of 3-pillar portfolios, so one pillar is high quality equities. So that part's still the same. One part is hard monies, commodity producers, kind of the more hard asset type of approach. And then the final pillar is cash equivalents. So that is a section that does get debased, but it can be used to kind of protect against volatility and rebalance into the other portions. And that, of course, will depend on how old the investor is. Another way of kind of thinking about it is you take the 60-40 portfolio, you take out some of the bonds and put something like gold in the place, maybe not for all of it, but some of it. And you take the equity side and you take a little bit of the equities out and put in some Bitcoin. That's kind of how I've tailored a portfolio because in that fiscally dominant environment, those types of monies, those types of more hard assets tend to be winners. So I think there's no world where it gets to be a multi-trillion-dollar asset and only individuals own it and not other pools of capital. I think that basically once you get this big and liquid, it's inevitable that either corporate entities or pension funds or even some sovereigns are going to want to own it. Basically anything that you're responsible for managing, if you become bullish on Bitcoin, it makes sense for you to add it to your thing. So that starts at the yourself and your family, and then it trickles into professional life for those managing other types of assets. So I think it's totally inevitable that if it's going to be successful, it's going to be at all these different types of balance sheets. As far as concentration risk, I don't really view that as a problem because it's a proof of work network, not a proof of stake network. And the concentration is thus far pretty manageable. So MicroStrategy has 3% of coins, roughly speaking. Potentially the more bigger concern is that a lot of entities use Coinbase as custody. So I think they have something like 10% of coins, which is not fantastic, but I think not the end of the world. People have to kind of remember that even back in say 2011, like with Mt. Gox, at one point they had like a double-digit share of the network. So there's always been these little pockets of concentration that spin up and then either get diffused or break in some capacity. So I think that the network is sufficiently spread out that that's not really a long-term concern I have. And I generally view it as inevitable. There are people that say that Bitcoin has in some way failed now because these large entities hold it, but it's a permissionless asset. There's no way to prevent large pools of capital
Right.
from owning it. And to the extent that, the Bitcoin proponents that think it'll change the world, um, part of that involves going through every balance sheet out there, including increasingly big ones. It even goes back to in 2010 when the late Hal Finney was writing about this. He was kind of doing back of the envelope math on saying, Bitcoin has this many transaction throughput, and if this many people want to own it, they're going to have to own it through proxies. So he was kind of analyzing the concept of Bitcoin banks back then.
Hmm.
So this has been kind of a known aspect from the beginning. And another one, Nick Szabo, he was one of the kind of the before Bitcoin came out. He was active in the field of kind of trying to create digital gold and other types of assets like this. And the way he envisioned it was a two-tier system where you have kind of a settlement network itself that's suitable for larger transactions, and then various mechanisms on top of that, whether it's software like Chalmy and Mints, or whether it's old school, just custody arrangements to allow smaller transactions and other things to scale. So I think that some degree of custody is inevitable, and some degree of connection between Bitcoin and everything else is inevitable. Again, as long as it's successful. I mean, if it's not successful and it just kind of rolls over, then it doesn't get into balance sheets. But as long as it continues to be dominant at what it does, and as long as it continues to be decentralized and secure, I think it will show up on more and more types of balance sheets, and it's mostly a one directional thing. I think until the past year, a big variable was it wasn't taxed well. Basically, for not tax, I mean accounting. Like it wasn't treated on accounting purposes very well. So basically, if it went down in price, they had to book that as a loss. But if it went up in price, they couldn't book that as a gain. So it just kind of ratcheted down. So they'd have to say, okay, here's our official financials, but here's like really what our financials look like, and that's not attractive to a lot of CEOs. In addition, it's because it's volatile. There's a lot of career risk where if you're already CEO of a company, buying an asset that can go down 80% at certain times and has introduces risk where they might not otherwise want it. Historically, the way the company's been dealing with this whole fiat debasement issue is they decapitalize themselves. They pay out dividends, they buy back their own shares, they purposely take out debt they don't need just because they're basically shorting the fiat currency. Like an example I like to use is that Coca-Cola has been profitable for like every year for like a century, and yet why do they have 40 billion or 50 billion in debt? And it's because they can. Basically, that if someone's going to offer them the ability to, issue bonds for 10 years, 20 years, 30 years at 2, 3, 4%, which until kind of recent high rates they were able to do. It's lower than their other cost of capital. They say, well, if we're going to borrow at 2% and buy back our own shares with it, they're arbitraging the fiat currency system just like everyone else. They're just doing it in a less volatile and explosive way as doing it with Bitcoin. And so that's been kind of the go-to choice for a lot of companies. Whereas Bitcoin is one, until recently, it wasn't really big and liquid enough to be on their radar. Then the accounting issues were there. And once those things were addressed, like now that it's a $2 trillion network, now that the accounting issues are addressed, we do see it popping up more. But I still think it'll take years because of the high volatility aspect of it, which means that it's more disposed that someone who owns a lot of the company. For example, Michael Saylor had dominant voting rights in the company. So if you're able to convince one person to make a really decisive move, that's where that tends to show up. It's also, I think, not an accident that Fidelity was earlier into Bitcoin than most other financial institutions, because that's a more privately held entity. So if the CEO was on board with it, it could happen. Whereas if you have a more diffused ownership where the CEO might only own 2% of the company and is basically just an employee there rather than like a true owner, you're less likely to get that kind of high conviction decision making compared to entities that have tighter ownership. That's also why you see a lot of small businesses, small private businesses will own Bitcoin. And you'll see a lot of people that are, they might be on the board of a pension, they might be on the board of a bank, and in their personal life, they might have a lot of Bitcoin because they can just make that decisive decision. But there's no one really in place at a lot of these types of entities that can just make a pretty decisive call like that if there's any degree of controversy to it, which there is because of the volatility and historically because of the accounting treatment.
Now, do you think in terms of long-term potential risks for Bitcoin that quantum could present a problem?
Over the long arc of time, I think it's worth monitoring. I've been able to talk to some of the experts that focus on this, so they kind of come up with their potential solutions and how they might address it. So just like how USB and Ethernet update over time, Bitcoin does update over time. In terms of non-consensus changes, there's regular updates, and then in terms of consensus changes, there's occasional updates that happen over time if a very large percentage of the network agrees to do it. And potentially they could replace the signature types with more quantum resistant signatures. The downside is they generally take a lot more space. And therefore you run into issues like the block size limit, the amount of bandwidth that is needed. So doing it prematurely is unlikely to be successful because there's going to be more pushback against the cost of that compared to doing it. So I think I'm optimistic that I know that there are solutions on the table. They might be just like how we talked before about the complexities of the fiscal budget, that there are solutions. They're just kind of hard to arrive at. The same is generally true for Bitcoin and quantum resistance, that if we do hit that point, there are solvable ways around it. And then, I still think it'll take many years to probably reach that point. I think we're seeing gradual diffusion because people, when they think about dollar losing status, their immediate thought is what replaces it. And the
Hmm.
answer is that there's no other fiat currency that has the characteristics to replace the dollar. And so, for example, after World War II, the United States was like over 40% of global GDP. We had all the
Whoa.
manufacturing base. Yeah, we had all the gold. We were the only entity still standing, basically. Everything else was rubble. And so you're in this kind of unusually dominant position. And we've been able to ride that now for 80 years. And so the U.S. is no longer in a position that's anywhere near that dominant. We're a quarter of global GDP on a purchasing power basis. We're even less, something like 15% on a purchasing power parity basis of GDP. But also China's not big enough. Europe's not big enough. There's no other currency block that's really in a position to just be the global ledger that everyone uses. So I think that the challenge on the dollar is not going to be another fiat currency. It's going to be one of two things. It's going to be a more of an interest in neutral assets, so things like gold and Bitcoin. Currently, by far, because gold's 10 times bigger, that's the preference that central banks have been doing over the past decade or so, where they're gradually kind of bringing gold back into the system to some
Mm.
extent. Even some of them were repatriating it because they were like storing it abroad, and some of them were actually paying the expense and logistics of getting it back in their own borders.
Whoa.
And then around the margins, there are some like El Salvador, the Kingdom of Bhutan, that get Bitcoin on their balance sheet, or in certain sovereign wealth funds, they have indirect exposure. So I think that will become more common. And then two, there can be more of a diffusion of currencies where there's no one currency that displaces the dollar. Let's say the Chinese currency goes from a 0% holding to a 5% to a 10% holding, for example, and you get more of this plurality, especially I think that basically that whole kind of the whole region around Asia is probably, I think, going to gradually a little bit get more in China's orbit over time,
Mm.
which I don't necessarily view as a bad thing. Because I talked before about the dollar hegemony has a cost to it. We overvalue our currency, and to maintain that status, we basically hollow out our industrial base. We run these big trade deficits with the rest of the world to get them dollars, because in order to use the dollar as a global reserve currency, they need dollars. And ironically, they get them through our trade deficits. So I think that
Hmm.
as we enter a more multipolar world, either because neutral reserve assets are more popular or because there's some degree of diffusion among the top five or so currencies, that actually takes some of the imbalance away from the US economy. And going back to my earlier point, if that's kind of acknowledged to be happening, there are ways to kind of make that transition more graceful than if they try to fight back and fully maintain hegemony, even when it's no longer even serving our interests anymore. So I think that's kind of the big risk there.
The idea of a U.S. strategic Bitcoin reserve is moving from speculation to real policy debate. With legislation advancing, signals from the White House, and growing global competition, many believe markets are underestimating the odds. Other countries are already exploring state-level reserves, while central banks quietly hedge against the weakening dollar. If the U.S. takes this step, it could mark a historic shift, turning Bitcoin from a volatile outsider into a core piece of national strategy. Momentum is clearly building, and the question is no longer if, but when. Neutral assets like gold and Bitcoin are becoming vital in a world where fiat dominance is fading. The real issue is how quickly this transformation will reshape the global financial order. Should the US build a Bitcoin reserve to maintain its edge? And do you see Bitcoin replacing the dollar's dominance, or simply coexisting with it? Let us know in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.